guys, welcome back to the Capital Mindset Show. Today, we're going to be doing a review of a stock we covered way back in the beginning of this channel, and that is Rocket Company, ticker symbol RKT. So for those of you who may not remember that, or maybe are new to the channel, we covered it extensively as the American VIE, right? An example of a company with a crazy structure. And for those of you who don't know what a VIE is, it stands for Variable Interest Entity. Typically, we're perhaps known by our audience to talk about Chinese VIEs. However, there are such things as American VIEs. We will cover another one in the future, but I'm just going to review this one here today. And this one was caught up in the whole shenanigans of, the retail investor trade, a lot of short squeeze hype. And we're actually going to discuss why that was not true. It was not really a short squeeze, and it was a classic amateur error to think that, or to think that it was heavily shorted. And it's not actually, when I say amateur error, it wasn't actually just the amateurs who made this mistake. It was also a lot of journalists, right, who are supposedly finance journalists who are supposed to understand the system and actually do research. And it kind of should show you a little bit about how much research they actually do. And as well as very prominent other creators who, I won't pick on them per se personally. I will say that the tools that they were using were faulty, right? And it's quite surprising because one of the tools is supposed to be one of the most highly regarded tools in the industry. Okay, and we'll get to that. So let's start, I guess, with the structure. And you guys may be familiar with the structure, maybe not. And I'll begin like this. So we have two classes of stock, A and D. And if you're thinking, where's B and C? Don't worry, they're gone. They were, just for the initial startup of this structure, they were created. And then now they're gone. So now you have Class A and Class D. What you kind of notice here is you have Dan Gilbert over here and you have Rock Holdings. Going forward, they are the same thing because Dan Gilbert owns Rock Holdings. So when I say Rock Holdings, I mean both. Okay. So Dan Gilbert and Rock Holdings are the only ones allowed to own Class D common stock. Okay. That's very important to note because as they sell Class D, it converts to Class A. Okay, I'll come back to that because I'll get to dilution in a moment. So Class A common stock has 20% voting power with 100% economic interest. Okay, and again, the goal of this video hopefully is to shed light to this so that you guys can learn a lesson from this as a case study for applying it into the future as to how the structure of a business can affect both the performance of that stock going forward into the future, as well as, your margin of safety and stuff like that. Okay, so again, when you buy Class A common stock, RKT, on the stock market, you are getting something that has roughly 20% voting power. So 20% control of what? Of Rocket companies. Okay, you have 20% control of that. And you have 100% of the economic interest. Okay, this is where we have the distinction of a VIE. Okay, where the economic interest is separate, the voting is separate, and you have all these entities intertwined. That's why it's called a variable interest entity. They can look very different from one another. Okay, so Dan Gilbert or Rock Holdings has 0% economic interest with Rocket companies. Okay, but they control 80% of the voting power. So they control the business. If they make a decision, it's going to happen. Okay, then from there, the Rocket companies owns 8% economic interest of the actual company that you really care about if you're investing in this thing. Because when you invest in this thing, you're thinking about buying Rocket Mortgage. So Rocket Mortgage gives 8% of its economic interest. So all the money that makes 8% is assigned to Rocket companies. And the remainder 92.05% goes to Rock Holdings / Dan Gilbert. Okay, so now you can already see the discrepancy between the voting power for the shares and the economic interest, because also those are separate arrangements. You can see here, they're two separate arrangements right here. This is the Class D, and then this is the non-voting common units, and the units are there. So there's a separation in the proportion of the economic interest versus the voting power, because you're saying I get 80% voting power, but I get 92% economic interest. And if you do a simple ratio, you'll find that the ratio for the Rock Holdings is higher than you, the common stockholder buying Class A. So you have more voting power versus your economic interest, but the economic interest is what you truly care about. So it's kind of weird like that. But that's basically because the Class D and Class A is 1-to-1 voting power. Okay. And you have 20%, okay, of that. So then again, that's where the discrepancy of the short squeeze occurred, right? So then what happened with the short squeeze? Well, what happened with the short squeeze was the tools at the time, or the data was not aggregated correctly on many platforms. And in fact, you had a lot of people saying that there was a short squeeze happening because so much of the stock was short. I think it was 50–60% of it was short. It was something crazy. I don't remember exactly what the number was. It's back in those videos. We mentioned it. And what happened because of that was the media was reporting on it, and I'll actually show you guys here. So I'll change my share screen, and we'll go to the internet to witness what occurred. And you can see here, you look up Rocket Mortgage short squeeze, you see CNBC. There's actually more of CNBC on here. I want you guys should watch the Jim Cramer one where the stock price was going up and he's like, I can't believe this is a short squeeze, blah, blah, blah. It's a fantastic company. And then you have me, Kevin, as a large creator, had 127,000 views. And then if you had watched that and you just, only saw that and you didn't have any further nuance, you would have just believed that there was a short squeeze going on. Not true. But I won't pick on Meet Kevin per se individually here. I will stick to the tool that he was using. And remember that a tool is just a tool. It doesn't make you a good investor. In fact, if you entrust the tool too much, it can actually be to your detriment. So he was using Bloomberg Terminal. Bloomberg Terminal is a respectable tool within the industry. Now, the problem with Bloomberg Terminal was it itself wasn't aggregating the data correctly because this is a VIE. It's a very complicated entity. Okay, so there are very well paid people who are paid a lot of money to design these entities so that for various reasons as to the benefit of those who are creating it. Okay. So with the respect to Dan Gilbert / Rock Holdings, they have a lot of ways in which they can benefit, which I will get to shortly. And that goes into the dilution factors. All right. But going down here again, you can see that there was a narrative of short squeeze going on. But when you realize that the shares, right, were actually looking like this, okay, now it starts to make a little bit more sense. And I hope I did so far a good job or a decent job in making this case. Okay. So with regards to, didn't mean to do that, guys. With regards to this, right, we now understand that about 20% of the actual shares outstanding were what was being calculated into the percent short float, which is why it was so high, because we're going off of a small denominator, not the true denominator, which counts all the Class D common stock. And why do we want to count Class D? Well, here's where I was getting to, guys. All right. So enough bearing the lead. So Class D common stock, if Dan Gilbert / Rock Holdings, if they sell Class D, what happens? Well, that Class D converts to Class A, right? This in a way is a dilution moment for Class A common stock holders, because if I buy one share of Class A, who am I competing with? Well, I am competing with ownership, and competing is a wrong word. Who am I sharing ownership with? I'm competing with, I said it again, sharing with other Class A common stock. So we have 10 Class A common stockholders. There's 10 in which we are sharing the profits from. And remember, we're only sharing 8% of the profits. Okay. But if Dan Gilbert / Rock Holdings, if they sell into that, those shares convert to Class A, and then Dan Gilbert / Rock Holdings gets cash, but those shares don't stay at Class D. They convert to Class A, and then they get a piece of the pie of the economic interest. And that's dilutive, right? So just by them selling their shares, it's dilutive to us. So that's terrible already. Because normally if I had, the CEO of Alphabet and he's selling his shares, just because he's selling shares doesn't create dilution, right? Okay. Because he's selling shares that already exist. Now, him receiving new shares as payment, that's a separate issue. Him just having 100 million shares, and let's say he sold all 100 million shares. How many new shares are created in that scenario? The answer is 0. However, in this scenario, if Rock Holdings says, I'm going to sell all of my Class D common stock, all right, if they do that, then all of a sudden Class A gets inundated with more shares, right, that all compete for that same 8% economic interest. Okay. Now let's go back, because there was some criticism we did receive in those videos about the buyback. And then subsequently, there was a video made specifically on the buyback. And now in hindsight, we can talk about it. Okay. So in hindsight, what this tells me, right, this buyback, which was $1 billion, was spread the love. It spread the love, basically, because remember that Dan Gilbert / Rock Holdings owns 80% of the common stock, really. So the market cap majority is owned by them. And then at the time, I think the market cap for common stock A was about $2 billion. And from that $2 billion, we had a $1 billion buyback. And the point of that video was to discuss whether or not that $1 billion would be used in the best way possible. And this was the best scenario that we described in the video, which was the $1 billion would strictly go to common stock A, and that Dan Gilbert would not sell into that. Okay. He would not sell Class D common stock while the company was buying back Class A common stock, okay? Because then that would have a neutral effect. Or if he sold more than was bought back, it would have a dilutive effect, okay? So basically, under the pretenses that not pretenses, but under the hindsight that rocket companies actually fell in stock value, we can then determine that, yeah, the buybacks didn't really go towards the common stock A because it was 50%, right? So it was maybe more of a mix or maybe more leaning towards dilutive factors than it was to accretive factors, okay? Because definitely, if you bought back 50% of the stock, it would not be down today. That would not be the case. So from there, I hope that that kind of makes sense. And then there's a bunch of ways in which there can be a dilutive factor. One, they can issue more Class A common stock. If they issue more Class A common stock, that doesn't affect Rock Holdings or Dan Gilbert per se, because they have a separate economic interest agreement here. They own non-voting common units, which are separate for the Class D common stock, right? The Class D common stock is there, and what they'll be doing is they'll be diluting their voting power. But as long as he has 51% of the voting power, he controls the company relative in all things voting and decision making. He won't actually gain any economic interest from this dilution factor of creating new Class A common stock. He will be giving up voting power, but not economic interest. The economic interest is tied separately outside of that, okay? So again, and these are actually their own units. And you can, again, tell that simply by just doing the simple math of finding out the ratio of voting power to economic interest. And you can see they're clearly not tied 1-to-1. There's not a tie 1-to-1. There's actually a separate arrangement going on, okay? And that's evidence of that. And again, if the Dan Gilbert buys back Class T common stock, he's basically buying back only his own shares and not giving it to Class A. But again, even if he does buy back Class A, you have to expect him not to sell Class D. If he sells Class D, it is dilutive still to Class A. So then it can neutralize the effect. And that's what I think most likely occurred. Okay. So that's pretty much it for that aspect of Rocket Mortgage. We covered that more extensively again in the other video, but going back again. So now you guys can appreciate or understand why it is these other creators, these news anchors, all of them were saying this was a short squeeze. Okay. I want to show you guys actually the price performance since then. It's actually been abysmal. And unfortunately, I remember that one of the creators was very much bullish on this company. And then clearly they didn't do the legwork necessary to appreciate the risks associated with the business like this. Because again, it goes far beyond the business. It actually goes into the structure. And like I say on this channel a lot, and I hope you guys get that or take away from this video, is that VIEs are dangerous in general. This is an American VIE. So imagine, again, we talked about Chinese VIEs, but grab American VIEs and turn them to 11, and then that's the risk associated with Chinese VIEs. So this is an American VIE. I will do another American VIE that's a lot less egregious, because remember, VIE is an umbrella term, right? It describes a structure or a set of structures, a way of structuring, and it can look very differently depending on the business. So in this case, it looks like that. And then in another case, it will look different, but they'll have similar characteristics, as in separation of economic interest and voting interest, as well as all these other entities that are having their own, interest, variable interest entity. You see, it's in the word. It's like you're using the word to describe, or the word to describe the definition. So that's basically what it is. All right. Anyways, on that note, guys, I hope you guys enjoyed this video. If you guys like content like this, go ahead and feel free to leave a like if you found this video helpful. If you know someone who's interested in investing in rocket companies, direct them to this video, send it to them. And hopefully this can help them before what perhaps is something that they don't understand the risks yet. And then maybe this video can shed some light on those risks. Maybe they look at these risks and say, well, it's worth it to me, and I make the investment anyway. But, it's good to have the information that is, well, technically freely available. I'm just condensing it together and hopefully explaining it in a good way. If there's anything you guys have a question about that I didn't do a good job of explaining, comment down below, and I'll be very happy to explain or to go a little bit deeper with you guys there. And then again, because the goal of this channel is to provide you guys with information. Okay. On that note, guys, I hope to see you guys on the next one, and take care. Bye.